Back, Meta shares down 27% from their February peak ahead of earnings and OT tonight. Let's bring in Evercore ISI head of internet research, Mark Mahaney, with what we need to watch most of all. How are you thinking about this going in?
I think the bar is going to be relatively low. I think people saw the Google results and maybe the Snap results from last night and are very concerned for good reasons about the advertising outlook that Meta is going to give. I don't think they're going to withdraw guidance. I think they'll give you guidance for the June quarter. It'll probably be a broader range, Scott, than they normally do. Probably be $3 to $4 billion, range. I don't think they'll change their capex guidance for the full year. I think they're going to keep right at that 65 billion. Maybe they shade down some of their expense guides. I wouldn't be shocked by that, but that's a possibility. But anyway, well, I like the stock here. I like it going into the print. I'm going to go out on a limb here. I think that at less than 20 times earnings, I think it's nicely dislocated, and it's a high-quality name. I think it's going to be one of the best performing, relatively, ad assets out there, almost irregardless of what happens later this year.
You got a tough job. I mean, all of you do who follow the stock and try and put a rating and a price target on it, just because of where we are in the fog of the trade war and everything else going on. I mean, do you feel like you almost need to take the guide at this point with a grain of salt? Because 3 months from now, who knows?
I guess so, but I think there's a lot of resiliency to the Meta model that may be underappreciated. Let me throw a couple of ideas by you. First is, this is one of the two largest performance marketing direct response advertising platforms out there. You only pay if you get a sale. Companies are going to want to still generate sales. And so I think that gives them a little bit of resilience. Secondly, I think a lot of their ad inventory is fungible, substitutable, and so it's not keyword dependent and it's not content dependent. They're going to put ads in front of you when you're in your news feed, when you're in your reels, based on your interest, and so they can swap around. If there's weak ad verticals, they can swap in some that are stronger. And there are some that are stronger, financials, for example, or media and entertainment, gaming. There are some verticals that still seem to have some strength. And then finally, I think some of this China exposure that I think investors are concerned about with Meta, I think is somewhat overstated. Yes, it's about 10% of their revenue comes from China-based companies, but those companies are still selling. They may not be selling into the U.S., but they're still selling into Europe, Latin America, et cetera. They're using Meta to get there. There's also this little bit of an interesting hedge. The worse things there are between the U.S. and China, the less chance of a TikTok actually staying in the U.S., and that's going to be a source of funds, I think, for Meta. So I think there's a little bit more resilience to Meta than the market makes out. That's why I like it here.
I was going to come back and say, well, China, you said substitutable in terms of ad. I was going to say, well, China ads are not substitutable. But do you think they can do enough in other regions of the world to make up for whatever downside, a 10% perhaps, comes from that area?
Scott, you're right. There's risk, but let's take those numbers. So if it's 10% of the revenue to Meta, it's not 10% of all that spend's going to the U.S. It could be half of that. China-based retailers advertising that's going to Europe or Latin America or other parts of Asia Pacific. This is not the only market in which they sell in. So it's not like it's a full 10% that's at risk. Secondly, remember, Scott, this is an auction market. So it's not like you just completely evaporate the 10%. What happens is the second bidder and the third bidder are going to come in and take that inventory. So you're going to have a little bit of pricing pressure, but it's not like you're going to lose all of that ad revenue. So I just think there's more resiliency as an auction market, performance-based auction market with global exposure, with pretty much every vertical under the sun operating in Meta. I just think there's more resilience than the market believes right now.
You're the third person I've talked to today about this stock going into the print. Regulatory doesn't even make the list. I'm somewhat surprised. How you not think that's a serious issue?
No, it's a serious issue, and I don't want to be. I want to be fully respectful of it. Personally, I find it a little surprised. I think the government's case is pretty slim. The DOJ's case is pretty slim. There's clearly competition in social media. I mean, you can see that when Facebook goes on and off and TikTok goes on and off. You can see where people go. And to think that there's a case against Google that doesn't list TikTok as a competitor just seems just as somebody in the industry seems odd to me. It seems it's extremely odd. But anyway, this will go on. My guess is, and the people I've talked with who know a lot more about law than I do, that the government's case against the antitrust case against Meta is pretty weak. There will be other regulatory issues. I think Google's got much more regulatory risk on this front than Meta does. So yeah, I think it's a risk, but I think it's more than priced in at this level.
Okay, we'll leave it there. Mark, thanks. Mark Mahaney.
Thanks, Scott.